All right, welcome to the show. Welcome to Be the Boss of Your Money. I'm Mitch Goldberg, your host. We've been doing this show a long time. We're going to continue to do it. The important thing today is what has changed. I'm always looking for things that could change our outlook. And the interest rate scenario that investors have been expecting. I was just out last week talking to someone who runs a sizable foundation, and he said, we expect rates to go down. And I'm like, there are no guarantees. Rates might not go down so fast because they just want to roll over their 30 and 60-day T-bills, which is fine. But, whatever, just part of the conversation. I bring things to you that I talk to people about every day, and I look for ways that things could not only affect your wealth, but how you could maybe capitalize on these things. So let's roll a quick intro. The something has changed in the market, and I think you need to know about it. I think you need to know what it's going to mean for interest rates. And here we go. Stick around. This is going to be good. This is going to be fast. If you have any questions, please ask me in the comments. I love hearing from you. It's the best part. It's the best part about doing this. And if you don't mind, give us a thumbs up, a like, a hate, whatever it is. It'll help to spread the good word of what we're doing here to the rest of your contacts. It all helps the cause. Here we go. All right. Thank you so much for joining me. I'm Mitch Goldberg. We're just getting started. So, what exactly has changed? What exactly has changed with regard to the stock market, the economy, and interest rates? Well, quite simply, the economy continues to hold up, not just hold up better than investors expect, but a lot better and for a lot longer. The economy is doing pretty good. There are reasons for it. The Infrastructure Act, the CHIPS Act, the number of factories that are going up around the country, reshoring, onshoring. When we have our supply chains overseas and we decide we want to start manufacturing more goods here, which is something that I think we could all agree on. Making more of our own stuff here is a good thing. More jobs, more money, keep the wealth here, keep the technology here, keep the patents here. This is a good thing, but there is a downside, and the downside is inflation. The leading cause for inflation over the last few decades is two things. Number one, technology, productivity. Productivity has surged. The computer, the network computers, cloud storage, wireless. And now we have artificial intelligence, which could add a whole new level of productivity to companies, to workers. The other thing is that we have spent decades moving expensive production in the United States to cheaper locations with cheaper labor around the world, in particular Asia, and in particular China. China was willing to manufacture some fairly okay goods. All right. The high-end stuff that they produce is because American manufacturing is there, but it's not just we outsource it to them, we run it there. We supply the manpower, or I should say the intellectual power. Having said that, we are moving production back to the United States. It's a good thing. It's good for financial security, national security, but it does take away from that low inflation. All these years where you could always get a good deal on a car or a good deal on a car lease. You could negotiate for things, and it's getting harder to do that because as the supply chains, manufacturing, and distribution moves closer and closer to home, it's going to take a long time for that to really get to where we need it. So these are some things that we're going to have to deal with. Having said that, the labor picture, the labor environment is holding up well, in spite of the fact that the U.S., the Federal Reserve, has hiked interest rates over 5%. Despite that, the main gauge that we look at for the economy is labor. The labor market is holding up pretty darn well. Now, I know what you could say. Well, what about a lot of it being, leisure and hospitality? A lot of it in food service or, but a lot of it's in banking. A lot of it's, a lot of it's in finance. A lot of it's in healthcare. A lot of it's manufacturing. A lot of it's industrial sectors. There's enough good news to go around, but we could always, if you look at any statistic, there's always good parts and bad parts about it. But overall, the unemployment rate has been below 4% for, I don't know how many months, 20 months or 24 months or something. It's been a long time. So having said that, inflation is not coming down like it was before. It was at 10% briefly, and it plunged all the way down to about 3%. But this last part, to go from 3% to 2%, the Federal Reserve's target inflation rate, it's getting hard to get there. And I don't know if it's really possible to get there unless the Fed raises rates even more and puts us into a severe recession. We will get there. But as it stands now, the Federal Reserve, I'm just going to say the Fed, it's like a tongue twister. It's late. It's been a long day, a nice weekend. Did you like that eclipse, by the way? When I heard that 90% of the sun is going to be covered in the area where I am on Long Island, I thought we were going to have like nighttime in the middle of the day. And it looked more like dusk. It looked more like, we've got about another hour to 45 minutes of sunlight left. There wasn't anything like dark or anything. And if I didn't know there was an eclipse, I might not have even noticed it. Kind of a letdown, right? Isn't it a letdown? And I saw a lot of people out there with those funky sunglasses, but I got to tell you, I didn't try it because I don't know where these are coming from. And just because they have a label printed on them that they're safe for viewing, I'd be wary of where you get those things. I really would. I would hate to hear about somebody who had a retina problem because somebody made fake solar glasses for a penny and sold them to you for $8 or something like that. And now your eyes are damaged for the rest of your life. Okay, but I'm digressing. So, and inflation, although it's come down a lot, it's not coming down more. In fact, it's starting to creep up a drop. And energy prices are up. And I could tell you that inflation is going down, but there's only two things that you really look at when you look at inflation. You look at the cost of food and energy, right? And then you get the inflation figures excluding food and energy to get to the core number. But the raw number includes food and energy. That's what it's called. The raw number is the inflation figures including food and energy, and the core number excludes food and energy. And why those sectors? Why so much focus on those? Because they're traditionally very volatile. So sometimes they add to inflation, sometimes they take away, but we want to get an idea of how everything else is affecting inflation. Cost of housing has stopped going up. Cost of rents in a lot of part of the country are going down. So there are some good things that will help keep inflation on the ebb as opposed to the flow, right? Does that make sense? Keep it a little bit lower. Inflation and wages do continue to go up in spite of the fact that inflation has come down. So that means real earnings power, real savings power could help fuel spending for the rest of the year. The bottom line is the economy is just plain old doing better than people expected. And as a result, those who expected rate cuts and expected inflation to come down more and expected interest rates to come down are reassessing the outlook and saying, we're not having a soft landing, meaning maybe we'll go into a soft landing and the economy will slow down a little bit, not enough to throw us into a recession, but enough to get the Fed to cut interest rates a little bit, the short-term rates that they get to control, and maybe enough to keep long-term rates lower also. Well, it's not happening. Now, this scenario that's starting to be built in is I was thinking maybe 2 or 3 rate cuts by the end of the year. I think we have to seriously consider I think we have to seriously consider that maybe we only get 1 rate cut this year. Maybe no rate cuts this year. Maybe we don't have any kind of landing and the economy just keeps marching forward. And I know every month people keep saying, this is it. This is the peak. Now the economy is going to go down. And I can give you a lot of reasons why the economy should get weaker. I can also give you the opposite. which is what makes this a tough game. This is why we always say invest for the long term. Don't worry about these short term vagaries of the economy and the stock market. We'll find a way. Corporate chieftains find a way to grow their companies. We wind up with those. We take some of the good with some of the bad. That's diversification. You don't know in advance what the good and the bad is going to be. That's why we diversify now. If we knew what the good and the bad is going to be, we just invest in the good. We don't know. Diversification, that's a strategy that reduces risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. Boom, I said it. Okay. So having said that, with inflation sticky, not coming down anymore, maybe going up a tick, with labor strong, it's making interest rates go up. And as interest rates go up, it changes things. The value of technology stocks improves when rates go down or when rates are expected to go down. But if we now have an issue where we're thinking interest rates aren't going down, they could go up a little bit. One Fed governor talked today about maybe a rate hike if we don't see inflation go down. Forget a cut, maybe a hike. This is starting to make people reassess their expectations about stocks and bonds. For me, I'm going to keep going. I'm in this for the long term. But if you're a portfolio manager and you're going to be, you're going to be eyed on how you did this quarter and this year, this is a concern, and it makes the market do things that you yourself don't understand, because you don't understand how people could think so short term. And I'm right there with you. When I say you don't understand, I don't mean to insult you and say you're dumb. I'm not saying that. I'm just saying that when people make decisions based on short-term expectations, things that they don't even know about that can happen in the economy, they don't have any great idea of how to forecast the economy, nothing better than you, but they're making the complete opposite decision of as you are, meaning you're holding, you're buying, you're investing in your 401k plan. It goes on and on and on. Some of these portfolio managers and hedge funds, institutional investors, they decide they need to sell because even though they say they're long-term investors, they worry endlessly about short-term performance. And when you take out the worry about short-term performance, you get to say, I held on to XYZ stock or ABC stock for 15 to 20 years, and I've made a ton of money on it. Because you're not worried about the short term. You're not worried about your stock going up or down over the near term. That's how you make the real cheesecake, the real money in the stock market. Long-term thinking. Don't worry about the short term. But the people who get all the press, who get all the media, who get all the coverage are the ones who are making short-term calls, because short-term calls attract us like moths to a flame. We can't get away from it. So we see people doing silly things with their investments. So I started talking about a foundation. I have to say I'm also on the board of this foundation, by the way, so I do know a fair amount about it. But we have limits in terms of what we can invest our money in for the foundation. And I'm not saying doing anything crazy, but their plan is to roll over T-bills, 30-day and 60-day T-bills. That's all they do. And some of the people in the foundation are worried that if short-term rates do go down, you'll have wished you locked some of that money into 5-year bonds, which is the longest that they're allowed to go out now in terms of length, duration. Okay. So they want to spread out the money between not just 30-day and 60-day, but between 1 year, 3 year, and 5 years. They're having trouble convincing their board to allow that because the board just sees the highest rates at the short-term end of the yardstick, right, of the yield curve. Why should I just take 60 days at 5% plus and avoid 4 point something percent on a longer-term bond? We're talking treasuries here, folks. We're not talking corporates or junk bonds or anything like that. So anyway, these are the kind of decisions that I help people make and help them understand. And if people's decision is still going to be the same, I still feel good that I helped educate them to realize that they really were making the best decision for themselves the whole time. Having said that, interest rates have gone up. In particular, the long-term bonds, we'll take a look at that in a moment, how it affected the market. But this is why it seems like the market is starting to stall, because the catalyst, Fed rate cuts and lower interest rates, it's starting to go away for now. But how long does it go away for? Maybe another 6 months, maybe for a year. And if that's the case, then stocks short term are too high and they'll be bid down because of sellers. And then people like us who invest all the time will snap up those stocks. But these are the ups and downs, the vagaries of the market. Let's take a look. All right. So the Dow is off 11, NASDAQ up 5, S&P 500 down about 2. This is about as flat a pancake day as you'll ever get. By the way, you can't invest directly into an index, but you can invest into a security that tracks or mimics an index. Gold is continuing its climb closer to 2,400 than 2,300. And that was having a lot of trouble sticking above 2,000. So gold, strong uptrend. Oil, strong uptrend. Oil stocks are considered now the new momentum trade. The 10-year yield at 4.42%. I think you see 4.5%. I think if you do see 4.5% on that, it's going to start to attract a lot of money. Where does that money come from? From money that could have gone into the stock market or money that comes out of the stock market, because a lot of investors are sitting on really big profits. And you know what? Why not take some money off the table, throw it into a 10-year bond and just protect some of it? Maybe you want 10 or 15% of your portfolio or more in bonds. The VIX is 15. It's come down a little bit today, but still above that typical 12, 13 range where we've been accustomed to. But we'll take a look at is the 10-year 4.42%. That's what we're watching. And stocks are going to key off of that. We hit 5% ever so briefly at the beginning of the year. It lasted very short term. I picked up some zero coupon bonds, 10-year zero coupons at that level. And I'm really happy I did, because for most of us, our bogey for fixed income is 5%. So if you can get 5% long term and lock it in, I think it's a pretty good bet for most people. It's a pretty good position for your portfolio. So let's take a look at what it's talking about. There's the battle of the Titans. Okay, let me put myself in here. All right. Wells Fargo hikes their S&P 500 target this year. This came out today to 5,500. Now keep in mind, the S&P 500 is at 5,200. Okay, so Wells Fargo sees 5,500 versus where we just said 5,200. So a little bit of upside. Could they be right? Could they be wrong? We'll see. But then Morgan Stanley, they see a no landing scenario, but they have a target of 4,500, which is 13.5% below last week's close. So this is why I think investors get confused, because the reason that there's two articles today on the homepage of CNBC is because one strategist is bullish at a big firm, another strategist is bearish at a big firm. This is what gets the views, what gets the clicks. I'm leaning more toward the guy with the upside, but for my clients, I'm not betting anyone's future based on what the market's going to do by the end of this year. We have stocks for growth over the long term. We have intermediate term bonds and some growth, and some value stocks and dividends, intermediate. And short term, my clients, I have them covered, and you should be covered too with cash or cash equivalents, just in case. So the idea is, don't worry about what the strategists say, and we all know this. I mean, we all know this. I think even if you work for one of these firms, and I have, I'm on Long Island, so I have friends who work at these firms. They're not calling up their clients and saying, hey, we're bullish. We think the market's going up. Let's put all your money into stocks. The other firm calls your clients and says, oh, we're bearish. Put all your money into cash. They don't do that. You still have to invest on your own needs, your time horizon. And what's the money for? What's the goal? And could you invest in a portfolio that you could stick with? Because I don't care how good a portfolio is. If you can't stick with it, then the portfolio is not right for you. It's got to be good for you, folks, not good by somebody else's measure. That's what we do here at Client First Strategy, by the way. Check us out, clientfirststrategy.com. So, what's the lesson of the day? Now you understand why it seems like stocks are stalling a little bit, because people are concerned about how high rates are going to impact the stock market. And people are concerned that if this rally was sparked since late last year because of expectations that the Fed would cut rates, and those expectations are dashed, what does that mean for the stock market over the near term? That's what this is all about, and that's what I want to talk to you about. So we talked about it. I'm going to get going. If you have any questions, reach out to me. You can contact me through our website. You can send me an email. You can send me a DM. I'm on Instagram, InstaMitchG. I'm on LinkedIn. You know my name. We're on Facebook, Client First Strategy. We're on YouTube, Client First Strategy. I thank you for liking and commenting and all those great things and subscribing to my YouTube channel if you watch me there. Until then, I'll speak with you soon. I'll be out for a couple of days this week, so I don't know if I'll be doing the show again for this week. And that's that. Got some good business to take care of, and I will talk to you guys soon. Thank you.